has been quite resilient to the turbulence that the world has experienced. We project growth this year at 4.8%. We expect growth to slow down to 4.2%, and that immediately answers your question. China is growing faster than the global average, and in this sense, it is contributing to global growth. China faces a fork on the road. Whether China would continue with the growth model that it had before, export-oriented, or it would reorient the economy towards domestic consumption. And the Chinese leadership recognizes that it is time to take this turn, to move the economy towards towards domestic consumption. What does that mean? There are three important priorities. The first one is resolve the real estate sector problems resolutely, get them out of the way. Why? Because they hold down consumer confidence as long as this problem persists. Two, increase social safety nets. Instead of investing in industrial policy, China has been spending about 4% of GDP to support industries. Redirect this money towards supporting social safety nets to boost consumer confidence and reduce the saving tendency, spend more, save a bit less. And three, China has a lot of opportunity to open up sectors that are currently not as market active, like services, from education to healthcare to other types of services. And I think that if China takes this turn, then it would be a major contribution to reducing the excessive imbalance currently China presents. And I think it is overall right for a large economy like the Chinese economy to do more at home than outside.
Okay. All right, let's go right here. First row at the end.
Thank you. Good morning, Madam Managing Director Kristalina Georgieva. Good morning, Madam Kozak. Madam Kristalina, you recently highlighted positive developments in Senegal. I'm the correspondent of the outlet, the Senegalese outlet 2STV. So, yet multiple credit rating agencies continue to downgrade the country. Could you share your perspective on this apparent contradiction? Specifically, to what extent might the downgrade be linked to delays in the IMF response to the hidden debt issue? Thank you very much.
Thank you for your question. I want to start by giving full credit to the Senegalese authorities for uncovering a major misreporting problem. There was debt hidden, and they brought it to light. Assessing why this happened, what is the magnitude, and what to do about it took some time. But now we have clarity, and once we had clarity, Senegal asked for a program from the fund, and I can tell you they asked and we immediately responded. I met with the Senegalese delegation here. We had a very constructive discussion on what the objectives of a program could be, how to go about it, and we are dispatching a team immediately after the annual meetings to Senegal. So in that sense, we acted as soon as conditions allowed it. We don't comment on rating agencies. you put this question to the rating agencies, what is our thinking? But I can say this, Senegal has a great potential. With sound management, the country can do so well for its people. And you're one of them, so best of luck.
Very good. Okay, let's go to the middle. Gentleman right here with the blue shirt, yellow tie. Yep.
Thank you very much, Managing Director. David Lauder with Reuters here in Washington. I wanted to ask you about something that is making the rounds in financing circles. Here, there's a couple of U.S. companies that have collapsed in the automotive sector, a parts company and a subprime auto lender. They got their funding from the non-bank sector, the private lending market, and it's raised some alarm bells there. Jamie Dimon the other day mentioned that if you see one cockroach, there are others. So I'm wondering if this is a concern for you about the health of the credit markets and whether this is something that could boil over into a crisis. And then furthermore, how prepared is the world to handle another systemic crisis that, you know, buffeted by crisis after crisis, there's not a lot of resources left in fiscal coffers. Thank you.
Thank you, David. We are concerned, and it came very clearly in the financial stability report we issued this week. What we have seen is very significant shift of financing from the banking sector to non-bank financial institutions, to a point that more than half of financing is now there. We know that the non-banking financial institutions do not enjoy the same level of regulatory oversight as the banks do. Therefore, if that grows significantly, then we risk, should there be a concern that you know, grows, that we may be in a difficult place. Whether that kind of problem can be more dramatic, of course, depends on two things. It depends on the performance of the real economy, and it depends on the magnitude of non-banking financial institutions that find themselves in a tough spot. And this is why we are urging more attention to the non-bank financial institutions. We are asking a question: what should be done to have more oversight, more, you know, a better view of what is happening there? You are asking the question that keeps me awake every so often at night. I mean, at this point, what we see is a world that has learned to operate with more responsibility, with better policy frameworks, and it is across the globe. It's not like we have a small subset of advanced economies with good fundamentals. We actually have many emerging market economies with very strong fundamentals. We also have lots of reserves. When you look at the systemically significant economies, they have accumulated massively reserves, or like the United States with the exuberant privilege of the dollar. In that sense, there is a better foundation. We are not where we were at the time of the global financial crisis. Lessons have been learned, actions have been taken. Nonetheless, we also have to recognize that countries have exhausted their fiscal buffers. I just talked about the high level of debt. Monetary policy is still wrestling with keeping inflation on a downward trend, with the exception of parts of Asia where actually disinflation went too far. And in this environment, of course, the security blanket is covering us, but maybe we have a foot out in the cold. So we have to be vigilant. What do? We watch it very carefully. Stretch valuations are a reality. We talked about AI. AI has created this enthusiasm. Very important bet, David. If this bet pays off, we are in a very good place. But what if it doesn't? Or it doesn't fast enough? So you are right to be putting this question to us, and I can tell you that we are very watchful on development. So far, not that many cockroaches.
Very good. Okay, let me go right here to the front. A gentleman in the brown jacket.
Morning. Thank you, ma'am. This is Deepak Ajwani from the Economic Times, India. You've had kind words for India, and you've called it an efficient growth engine, thanks to the reforms put out recently. India wants to do much more and contribute to the global economy. But just when India and Asia wants to contribute, the world is clamping down. Multilateral trade is under question. What is the solution for this? Because if the advanced economies want to stop trade and let the emerging markets not grow further, how will the global economy pan out from here? Should they be more generous and have more emerging market countries grow and contribute? What kind of reforms should India adopt, and what kind of geopolitical relationships should it develop so that this imbroglio goes away?
Excellent question. So India is one of the fastest growing economies, and given its size, it contributes to global growth substantially. India is where it is because it has pursued very significant reforms. Tax reform, investing in infrastructure, digital infrastructure, but also roads, connectivity in the country. And that has injected this growth potential. Now, indeed, there is a significant change. The largest economy in the world has chosen to use tariffs as an instrument in relations with partners. Here is the interesting fact today. The rest of the world has not followed so far, and I want to put the emphasis on so far. Out of 191 members of the IMF, we have seen only 3 moving more forcefully on tariffs. Of course, first the United States, China, and to a certain degree, although there have been significant adjustments, Canada. 188 countries said, thank you, but no thank you. We prefer to continue to trade on what was the term? Most favored nation rules. And we are encouraging countries to please do that, because unless you are very large, relatively close economy, and India is not, it's an open economy, it doesn't work well for you. We also are seeing very interesting phenomenon, and it is the increase in regional trade integration. And actually the ambition for regional trade integration is growing in many places. In Gulf Cooperation Council, in ASEAN, we see in Central Asia more interest to trade. And I think for India, that takes me to what can India do. One, India itself can aim for a higher degree of trade integration with partners. India has still maintained some barriers to trade. There are tariffs that India imposes. There are some restrictions. And it is good to think about where do we want to go? Do we want to go in a direction of maintaining and increasing these restrictions, or we want to go the other way, integrate? And if I take the relations with the EU, the signal seems to be, yes, we want to trade with others, we want to have more openness. The second thing India can do is just to continue doing what it has worked for it, pursue reforms. There is a lot that can be done in education, increasing skills capabilities, reforming sectors to open them up for more private sector initiative. India does have space for smart regulation to move, self-inflicted injuries, get them out of the way. And I think the strategic direction of India, look at the future sources of growth. Where is the economy, the world economy, likely to go next? Demonstrably, the International Solar Alliance is a signal that India is thinking of that pursuit of opportunities.
All right, let's go second row, man with the yellow lanyard. Yep, right there.
Hello, Jeremy Warner from the Daily Telegraph in London. We've seen a significant rise in term premia of late, particularly in the UK, but also globally. Is this now the new normal? Indeed, they've returned really to the sort of levels we saw before the global financial crisis. So is this the new normal? And if so, what are the implications of that, particularly for countries with high sovereign debt?
Well, this is why we are so loud in our call for fiscal consolidation and reducing debt levels across the world, because we should not be surprised if you look at the current debt composition. Big chunk of it was accumulated when interest rates were close to zero. Well, there is a moment when you need to refinance. You're refinancing in a different environment. Demand for refinancing and also access to financing is quite high. If you look at the one of the reasons why the world economy is doing relatively well, it is easy financial conditions. Even frontier markets are able to borrow at not the highest of cost. But when you look at the longer term, then you see what? You see the reflection of uncertainty. Okay, I'm going to lend you money. You're going to pay me 10, 15 years from now. You need to pay me a little bit of premium because of this uncertainty. So I think you're right to put it in a sense that this is not a blip. This is more likely a trend towards somewhat higher reward for especially longer term. But if government, let me put this again, if governments bring their debt levels decisively down in a medium term, not only that, if they signal they're doing it, and in this sense the UK is doing the right thing, they're signaling that they have a growth vision, but they also have fiscal responsibility. So you signal, and then the markets are going to be kinder to you.
All right, let's go right here to the front. Women in the green.
It's me, Rulat Taraune from CNBC Arabia. My question is about Middle East. Do you think that the Middle East region will regain economic stability after 2 years of geopolitical tensions that have affected Egypt, Jordan, Lebanon, and Syria?
I am like, I'm sure everybody in this room, everybody on this planet, breathed a sign of relief when ceasefire was reached. For the sake of the people that have been affected, those waiting for their loved ones to go back home, those waiting for peace so they can move more freely in Gaza. It is important, of course, that everybody concerned encourages this direction of sustaining, lasting peace. And yes, it would benefit the region. Just think about Egypt. Less tensions means good news for the Egyptian economy. Same for Jordan. For Lebanon, we have Lebanon put a request for a program. With Egypt and Jordan, we have programs that are doing quite well. Lebanon has requested a program. I hope we would be able to come up with a program. Syria asked us for support to rebuild institutions, especially the central bank. We have already had a team in Damascus. So when there is peace, there is also this benefit that those who are there to support you, it is easier, more viable for this support to come. So absolutely there would be a peace dividend for everybody.
I'm going to go to another, we have time for one last question, so let me go into the audience. I'm going to go right here in the middle, man in the white shirt. This will be the last question.
Thank you very much. Thank you, Julie. Good morning. Good morning, Managing Director. My question is about inflation. As you pointed out, most of the central banks are still wrestling with a relatively sticky inflation. Are there any concerns that the ongoing trade tensions, specifically between China and the US, might have spillover effects on inflation around the globe at some point? Thank you.
What we see on the inflation front is overall inflation is trending down with some differences. In Asia, down, up to a point like in China where maybe a little bit of inflationary impulse could be a good thing, to somewhat higher than target, well, around target in the Eurozone and somewhat higher here in the United States. When we look at the impact of tariffs, as I said in a previous answer, we have one country that is more engaged, another one that is responding. The rest of the world is, for now, not becoming part of a trade war. Meaning that for these countries that are on the receiving end of tariffs, tariffs act as a shock that contains inflation, doesn't increase inflation. But for the country that is originating tariffs, it is push of prices potentially up. So far in the US, the impact has been mute. Our explanation is threefold. One, companies, importing, exporting companies have been doing well. They have good profitability, so they can absorb some of the tariffs in their profits. Two, there was a lot pre-positioning that allowed pre-tariff prices to be maintained. And three, the likely adjustment of supply chains may also ease this impact. If there is flare up of trade tensions, that would of course have a negative impact. And again, this is why we are saying, please don't and don't do that. It is not a healthy action.
All right. Well, thank you very much. This brings us to the end of our press briefing. Thank you, Managing Director, for joining us. Thank you all for joining us. We will post the full transcript of this press briefing on our website. And of course, if you have further questions, my colleagues at media.org, the IMF media team, are available to talk with you.
Thank you
so
very much, everybody.